Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're joined by Mark Crandall. Mark is one of the founding fathers of the trading houses and the commodities sector as we know it today. Starting his career at Morgan Stanley before joining Marc Rich, and then as we'll hear, being instrumental in the founding of Glencore and Trafigura. Today in part one we cover his early career, leading up to the famous split at Marc Rich, and then in part two next week we'll dig deeper into Mark's thoughts on trading houses, why they've come to dominate the sector, and what the future might hold. As always, you can really support the show by leaving us a positive review on the platform you're listening on. Well, Mark, welcome to the show.
Thank you. I'm happy to be here.
Yeah, I'm looking forward to this, and special thanks to Colin Bryce and his book, The Rivers of Money, for bringing us together. So we're talking about, in part, your career and how fascinating career that you've had, and then secondly as well, talking about the trading houses themselves, which you have been instrumental in creating, one of the founding fathers, how they've succeeded to dominate the industry over the last decade and what the future might hold for them. So can we get a bit of an early bio on you and how you ended up working with Marc Rich Co, and just start us off in the early days. How did you get in the industry?
Well, I came into the industry via Morgan Stanley. So I got out of university for your British audiences, in 1980. And that was before the so-called Wall Street refiners had really happened. And through a personal friend, I got introduced to Morgan Stanley, and they hired me as a young analyst in the strategic planning department. And the first project I worked on was a project to start a commodities trading operation at Morgan Stanley, which they duly did in whenever it was, 81 or 82, probably 82. And they hired a guy from Goldman Sachs, the commodity division of which was called J. Aron in those days. And Goldman was, along with Salomon Brothers, one of the two Wall Street companies that had a significant commodities operation, but it was focused on, in the case of J. Aron, gold, silver, some coffee, but not oil. So oil was a brand new thing. And we started as gold and silver traders, so as it were, sort of mimicking the J. Aron playbook. But we soon decided it was time to go into oil, which was just beginning to have active futures markets, and the physical traders of oil in those days were entirely disconnected from the paper markets, which were brand new and very lightly used by professionals. So that's how I started, and it was from there that I moved over 4 years later to work for Marc at Marc Rich.
Just so we're all on the same page, what was it that the early Morgan Stanley commodities desk was doing? What did it mean to be a Wall Street refiner? And how quickly did sort of that opportunity suite get recognized by the bank?
Well, when we started out, we were doing gold and silver trading, very much following the London Metal Exchange and the fixing dealers in London. It was a world where people traded gold and silver in the so-called physical market, but separately there was a futures market. So essentially, the Wall Street gold and silver traders were arbitraging between the traditional, what we call the upstairs market or over-the-counter market, in gold and silver bullion, and we were arbitraging that against prices on the COMEX, the Commodities Exchange, New York Mercantile Exchange was the actual name of the exchange. Essentially, when they introduced oil futures, we decided to follow essentially the same idea. So you already had a 15-day Brent market, which existed. And we set out to see if we could reasonably arbitrage between this newly created futures market in New York, which of course was trading WTI and Brent, which was not exactly the same commodity, but these were the only two genuinely forward markets that really existed. There was a little bit of forward Dubai trading, but it was insignificant in volume. So essentially, we were trying to find a way to kind of integrate the forward Brent market with this new um, NYMEX WTI market, which had come to existence in New York.
How did you understand and figure out these markets? Where was that knowledge coming from? And then secondly, just because I think it would be edifying, is kind of, did this sort of quickly become evident that it was a huge opportunity? How are you guys getting paid? Like, what was the wallet like at this time in for Morgan Stanley and the commodities?
We did realize there was an opportunity. The guy who had started the commodities department at Morgan Stanley was a really decent human being, very, very nice guy called Robert Feduniak. I don't know what became of Bob, but he was a terrific boss. So everything there was to learn about commodities trading, he basically imparted to me as his eager young charge, as it were. I was the only really young guy on the desk without experience, and he was unstinting in his time to educate me. That was there. The second thing was that he had the foresight to hire two people from the oil industry that came from the background that I would later become part of, and you were part of. But of course, Morgan Stanley knew nothing about this world except, from a corporate finance perspective, they had corporate finance relationships with the big oil companies, obviously. In fact, Morgan Stanley probably had an especially good relationship because at that moment in time, circa 1982, they were kind of the preeminent New York investment bank. But they didn't know anything about the trading with these companies. So we hired a fellow called John Shapiro who came from Conoco, and a woman who came from Sun Trading, which was part of the old Sun Oil Company. And these two really brought this perspective on what everybody was doing and gave us some insight into the potential scale of this business. And we quickly realized that this could be really, really big, but we would need to link the external world, which was not based on WTI, obviously. That was at this moment in time, WTI was something US domestic refiners looked at, but nobody from the outside world would pay any attention to it. There wasn't a futures market until the NYMEX came along. It wasn't something that was exported or used abroad. So if you were a European refiner, you may have read about WTI, but it certainly didn't have any impact on your daily life. And suddenly here we were with this new futures market talking to European refiners and trying to make the case that they should consider using this new futures market as a way to hedge price exposure.
I guess this came out of Colin's book as well, though. It doesn't sound gauche to us, but it's going to be important, I guess, for the trading houses we were about to discuss. Wall Street entering the commodity trading game or the energy trading game had a dramatic impact on bonus culture, on the compensation of traders. Can you just, I mean, it would just be interesting to know, sort of 40 years ago, kind of how they paid you, and was that taken from the rest of the bank, or was it, just give us some sense of that.
At the beginning, we were treated, I think, like all the other traders in the bank. Keep in mind that trading culture had already arrived on Wall Street, although Morgan Stanley was really the last of the banks to have a trading culture. So to situate this conversation would be very different today. But in 1982, if you walked into Goldman Sachs, the heart and soul of the organization was the equity trading operation. All right. If you went into Solomon Brothers, which acquired Philip Brothers, Fibro, during this time period, during the same epoch. They also had a really rich trading culture at Solly. Morgan Stanley was uniquely Gentile and what we used to call white shoe, very sophisticated. And Morgan Stanley mostly did corporate finance transactions. It was not a trading house. So bringing this new commodities operation into Morgan Stanley was at the same time that they were under the same boss, bringing in an operation to trade foreign exchange. This was really a new thing for Morgan Stanley, and I think there was a certain amount of culture shock that you had businesses that were just about trading and had no relationship to the existing client base and the existing merchant banking operations.
The narrative has always been there about, look, this is a commodity trading desk, allows us to price risk for our customer base. And these things, there should be this sort of nirvana-like state of interaction between the financing groups and the trading groups and flow and all this good stuff. Did Morgan Stanley care that you guys were offering a service to their clients? Was it seen as that at all, or there wasn't really much connection?
Listen, the senior management of the firm really interacted with us and made an effort to get what we were doing. We participated with the equity research guys to give our insights into the commodity markets, and certainly senior management knew who we were. So they were making a good effort to do this, but it took a while for Morgan to change into a real trading place. And another good example, which you may be more familiar with because they made an excellent play about it, which was Lehman Brothers. Lehman was also a merchant banking operation that gradually changed during the same period into a very trading oriented place. Trading really began to dominate the corporate finance business rather than the other way around.
The story, I guess, starts in some ways. You get this early start, and as often happens in this sector, right? People sort of, a lucky chance or a family connection gets you within it, and you're in right at the ground floor and spend 4 years at Morgan Stanley being part of building this new sector, really. And then Marc Rich comes a knocking. Tell us about how that happened and why you decided to join.
I'm afraid I wish I could tell you that I was such a stellar performer that the people at Marc Rich heard about me and reached out, but it was actually much more mundane. Marc Rich and indeed Fibro, the other very large physical commodities trader in those days, it was independent, were really different from Wall Street. I mean, they had little, if anything, to do with this kind of, let's say, price arbitrage. It was a very, very different business, very physically oriented. And along about this time, I found a woman who I eventually married, but who probably at this moment was my fiance. And her brother worked at Marc Rich. And I spent enough time with him that he realized that the sort of oil business that I was doing at Morgan Stanley was completely different from anything that they were doing at Marc Rich. And he persuaded Mark to give me a shot to come in and, I don't know, impart this new perspective to the operation that already existed at Marc Rich.
And by that you mean, so essentially you had that financial hedging, financial markets knowledge to come in and actually append that and into their physical trading activities.
Absolutely. And this was especially true with oil. I have to say some of the financial concepts which are completely routine now to the point that I think kids probably know them, but things like contango and backwardation, it's difficult to grasp, but in that era they didn't exist in the oil markets because to have contango and backwardation you have to have a forward market. And there really wasn't one. There was the 15-day Brent market, so you could see intermonth price differentials in 15-day Brent, but it only went out 2 or 3 months. Nobody was trading 1 year forward Brent in 1982.
It was all alchemical, right? I mean, like, I think options had just been invented by Black-Scholes, the option pricing.
Absolutely, no, no, very much so. In fact, my second year at Morgan Stanley, we built using Lotus 123, if you can even remember back that far, the predecessor to Excel, which obviously came to dominate the spreadsheet space. But in the day, whenever that was, 81, 82, Lotus 123 was the Excel equivalent to go to. And we took the original Black-Scholes paper and copied the formulas, more or less longhand, into 123 and built a really primitive options pricing model. And then we went out, this is for gold and silver, we went out and started asking the existing options traders for quotes and discovered that the way they were quoting wasn't based on Black-Scholes. It was just based on their own intuition of what seemed like the right price. So we'd ask a guy for 4 or 5 different quotes and they'd be spread all over the place and they wouldn't have internal consistency, at least consistent with Black-Scholes. So yeah, this was all completely new. But metals traders did have a forward market. So if you went to a place like J. or any of the Aaron was on Wall Street, but they had originally been an independent physical trader, just like Marc Rich and the other physical traders. The metals people in those organizations knew about contango and backwardation. There was nothing new for them because that was a big part of how people traded physical metals was trying to take advantage of contango and backwardation. But for the oil people, it was all completely new. There was a whole dimension of trading that gradually opened up in the second half of the 80s and, of course, became gigantic as it is today.
So, what made you join Marc Rich, and what was he like?
I wanted to join Marc Rich. I mean, maybe I was a bit headstrong. With the benefit of hindsight, I'm still glad I did it, but it was a bit impetuous because we were building what became the largest of the Wall Street refinery activities. Morgan really became incredibly successful in that business. It just made an absolute fortune. This is after my time, after I had already left, obviously, but the same people, Nancy Kropp and John Shapiro, who had started it. John led it for many years with the able help of Simon Greenshields, who later went to Fibro, and a variety of other people, but they became really a seriously dominant presence, all right? But not in that era. In that era, we were doing low level arbitrage between Brent and WTI, doing a little bit of speculation. We started trading options on WTI and options on 15-day Brent, but everything was about price. So the exciting world of real oil, where people produced oil in far-flung countries that were significantly more exotic than the suburbs of New York City, I thought, geez, that looks way more interesting than trading the price of 15-day Brent. After all, there's humans involved, there's oil ministers, there's government policy, there's security concerns, there's many more dimensions, all the things that have always lured people into the oil market. It's a really interesting thing. So I decided professional success at Morgan, even though it was well remunerated, and I had a relatively senior position working with John and Nancy running this thing. I was, eager to learn something new. So I thought, what better place to learn it than going to work for Mark?
Just out of interest, Had they realized that there was this burgeoning financial trading opportunity suite, or was it sort of happenstance that your future brother-in-law introduced you to it?
I think they knew it was out there, but they didn't really understand it. And to be honest, either did we. We didn't understand quite how profound that change would turn out to be. The market became much bigger. If you'd asked me in 1985 or 1986 how big this was going to become, I would have been off by an order of magnitude, I think. It was obvious that there was something there, but it seemed like a little bit of a sideshow.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
It'd be great to talk about Marc Rich himself, what he was like, but also Marc Rich is sort of the trading house that, someone in the early stage of their career in commodities might not know about, right? But was sort of the progenitor, the founder, and many of the traits originally in that trading house are what are built on to become Glencore and Trafigura and Mercury and the others and so forth that had this phenomenal success.
Very much so. I mean, the story, which is possibly apocryphal, is that Mark left Fibro because he disagreed with the titanic figure who was behind the Fibro of the 1970s, which was Ludwig Jesselsen. I never met Jesselsen, but I'm sure he was a very interesting guy. But he and Mark broke because Mark saw the possibility of trading oil in the same way that other commodities are being traded. Keep in mind that when we started Morgan Stanley's oil department, which I think was either 82 or 83, I'm going to say 83, that seems more likely. And we hired this guy, John Shapiro from Conoco. John told us about oil that was produced in Syria, for example, which only 10 years earlier was trading for 50 cents a barrel or $1 a barrel. When they would have the quarterly price negotiations, they were talking about 5 and 10 cent arguments over the price. The price of transportation was far higher than the price of the oil. And all this changed, of course, dramatically through the two oil price shocks or oil embargoes or whatever word you want to use in 73 and 79. The 1973 oil price shock shook all of that stuff out of the ancient world and into a world where the price was higher. And then in 79 with the Iranian Revolution, there was round two, and you had suddenly really, really expensive oil prices. But this was a brand new thing. This was a $1 a barrel commodity at the turn of that decade. And by the end of that decade, it was, I don't even know how expensive it was in 1979. I was a kid in high school, but it was compared to 1970, 40 or 50 times higher.
And if you owned the capacity, the logistics, or the contacts and the capacity to get that oil from those local, doing hard things in hard places, right? That was sort of the, solving problems in time, location and form suddenly became incredibly lucrative.
Absolutely. There were tremendous dislocations which were normal. For example, in the mid 70s, pretty much any government that sold oil had an official selling price. Because if you lived in a world where the price moved by 5 cents a quarter or 15 cents a quarter, it was an administered market. So, the government of Nigeria would have an official selling price, and that's the price at which they sold oil. And suddenly you have these oil price shocks, and the price of oil could be $10 a barrel more expensive than the official selling price. Well, obviously, when that sort of situation occurs, there becomes an instant, let's say, shortage of oil at the official selling price and a huge benefit to anybody who can get a contract at the official selling price. So this obviously gave rise to a lot of skullduggery and influence peddling and all the rest of it, because there were suddenly fortunes to be made if you could just buy oil at the price the government thought they were supposed to be selling it at, because the price in the real world was dramatically different. And honestly, I would say a good portion of the governments hadn't really kind of processed all that information by then. So there was probably considerable confusion. Some governments, I think, had processed it all and got what was going on, but exploited the opportunity to reward their political friends with oil contracts and all the rest of it.
Be good to get a sense of how Mark struck you in those days, and Pincus Green and so forth. And then I guess I understand there's a mixed legacy here in some ways, right? But when you look back and reflect on it, this was the early stages of creating a market for oil that ultimately has led to what we see today, right? Which is sort of ultimately solving for lower prices and all the rest of it. Or was it there were dollars left on the ground, there were huge arbitrage opportunities and you just had to be swift and be able to get them? Or was it sort of actually the underlying competitive advantage was skullduggery?
This gets down to, I guess, how you want to characterize skullduggery. There were things that the major trading houses did that were, for example, against the law in the United States, but not against the law anyplace else, and may not even have been a bad thing to have done, but they did them anyway. So you had, for example, if you look circa 1980, one thing you had a lot of was trying to purchase oil that, under the rules of the United States for tax purposes, this is something that I think Nixon first introduced, but it got later elaborated and became really significant at the end of the decade when the price of oil got higher. There was a differentiation between old oil and new oil. And the theory was, we're not going to let guys who were making oil before the price went up make a windfall profit from the fact that the price is now 10 times higher than it was before. We would like that price signal to be delivered to somebody who might otherwise not drill a new well, but would drill a new well, knowing that he or she could take advantage of the higher price. So the concept was to have two parallel markets with two different prices for oil. And you can imagine how that ended. It ended with elaborate chains of transactions that miraculously turned old oil into new oil, of which all of the trading companies were accused. There was also, at the same time, obviously the Iranian hostage situation, which led to sanctions on Iran, at least from the United States, and therefore trading companies which continued to do business with Iran were technically breaking U.S. law, even if they were sitting in Switzerland and had no contact in the U.S. And you may remember that Rudolph Giuliani, who later became famous as Trump's attorney, before that was mayor of New York. In this period that we're talking about, which is the
Attorney General of the Southern District, right?
correct, he was Attorney General of the Southern District, and he made it his particular mission to go after Marc Rich, the man. So, sitting at Morgan Stanley before I took this job at Marc Rich, I was very aware of all of the stories about Mark because Giuliani, rather flamboyantly once stopped a 747 about to take off for London, claiming that Marc Rich was smuggling papers from the New York office to Europe. It was all contrived. The sending of the papers had been pre-approved by his office, but he got the TV cameras there and he made a real palaver out of it. And so that was in the news. And then I actually met the guy, and I really liked the guy. And I continued to like the guy for the entire time I worked for him. He was very measured. He was about the same age as my dad. They were the same generation. I think he was fundamentally very shy, but he was a great judge of people. People at the time would frequently attribute superhuman characteristics to him at calling the markets and making money, but that to me was never his great strength. He was an okay trader. He was, you can't survive in that business if you're not. But that wasn't his signal characteristic. His distinguishing characteristic was he was a great recruiter of people and leader of people. The people who worked for him were intensely loyal to Mark and vice versa. He was really good at managing that process. When I later, in a later upheaval at Marc Rich, became the head of the oil department, which happened in 1992, Mark and I went back and forth on whether or not I was ready to do that job because I was still a relatively young guy. I was 34 at the time. And Mark had his doubts. And I sort of pushed the door open, as it were, to the corner office. And that was clearly part of Mark's calculation. With the benefit of hindsight, he was clearly setting tests to evaluate the character of the guy that might become the new head of his oil department.
I find it fascinating, right? Because that to me seems, and it's kind of like the very heart of the story we're telling and you're sharing. And maybe some lessons today where actually we've been, oftentimes it's the best trader that can get promoted. But today that best trader might be sort of a savant when it comes to numbers and patterns and stuff, as opposed to historically, which was really about can you build a team and can you and build relationships and judge people as well, right? That sort of intuition about how people are going to respond in any given moment, but also how they might fare in challenges and so on. And that seems to me to be at the core of that Marc Rich diaspora, that leadership team that then went on to do transformational things, Claude and Ivan and these names that dominate the sector for the next 20 years. Can you just talk a little bit about the leadership team that he developed? And it seems to me that what Marc Rich imparted to you and to them was it was always about people, both developing them, training them, unlocking them, but also about relationships. It wasn't about the sharp-edged trading stuff.
You know what it was? It's the same reason I was tempted to leave Morgan Stanley. It was not primarily about price. Price at the end of the day is what you're trading. After all, you got to buy low and sell high. That's what trading is about. If you're going to make a profit, you got to buy it for less than you sell it for. So price obviously was an aspect of what we did, but just compare and contrast the two approaches. A guy who was a purely price trader could pick up the phone and call the New York Mercantile Exchange and buy WTI in the morning. And if he was right on the direction, sell it in the evening or sell it 2 weeks later and record a profit and legitimately, in a way, I don't want to say legitimately because I think it's more complicated compensation and how compensation should work, but in his mind at least, legitimately go into his boss's office and say, I did this with no help from you. This is sui generis. I predicted that the price of oil would go up and I bought it and I sold it. And I don't need to be surrounded by your roof and your walls to have done that, except to the extent that you finance my margin. So I want a percentage of what I make. And if you look at how compensation developed in the Wall Street trading houses, it tended to have a very individual results oriented focus. A lot of the banks, when they were recruiting people, would offer them 10% of what you make or 12.5% of what you make or whatever the number was, with this kind of model that the economic actors were isolated and trading their own book and making their own money. All right. Compare and contrast that with how you would need to make money in a physical trading environment like Marc Rich. Well, first of all, maybe you were trying to buy a cargo in Nigeria at OSP plus something, some premium that you were paying to an intermediary. Well, first of all, the intermediary had to be willing to negotiate with you and not, for example, with good people over at Vitol or the people someplace else. So you needed a personal relationship there right in the first instance. Secondly, the oil minister probably had to bless the transaction so that the intermediary knew that if he sold to you, he wouldn't get in trouble and get blacklisted and not have the opportunity to do it again. So he wanted not only to have a decent relationship with you, but also to know that you had a working relationship with the minister. And then, if you were going to get that cargo out of there, you needed to get a ship under it. So you needed a relationship with the people who owned the vessels, who would trust you to lift this thing, even if it wasn't in the Nigerian program and they couldn't verify the cargo existed, but you knew it was there and it was there. And the vessel owner would take your word for it because you had a trust relationship. Suddenly you're talking about 3 or 4 or 5 people that need to be involved to execute that trade to get the low price cargo. You can't just pick up the phone and buy it.
And things that happened 2 years prior to your arrival, right? I mean, there's foundation and building blocks way back in the day before you got to the point of making that call.
Absolutely. Absolutely correct. Takes a very long time. And that's part of the reason. There's many reasons why the biggest trading houses, meaning the places like Traf, are so dominant. But one of them is this is a very difficult business to enter. There, the old business school stuff about having moats around your castle, economic moats. There are a lot of economic moats here. It is not a trivial thing setting up a physical trading hub.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organizations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our 3 main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
And those moats have gotten deeper and wider, right? With the advent of, the scaling having its own quality, but that's where we haven't really we've seen consolidation and we haven't seen many come along. We're going to tell that story in part 2. And I think it's fascinating to talk about compensation. We'll talk about that as well. But I think it's where actually that percentage model never went into those top trading houses, right? Because they recognized it took a team. Yes, there was bonus pools generated and those would be split up and it's been very lucrative. And it seems to me where you've had some challenges when you've had that Wall Street percentage of book or the hedge fund percentage of book blend into that physical world.
This is absolutely correct. But I can tell you when I was working before I took over the reins at Marc Rich, I worked very closely with Claude Dauphin, who was my predecessor in that job. And we discussed this topic ad nauseum. I mean, you have no idea how important getting compensation right is and was in a trading company. It is one of the all important things.
Yeah. Well, the quantum has to be.
Well, the quantum got bigger. You're absolutely right, because the amount of money that the companies make got a lot bigger. So and that was after I left the business. So I never really lived through that massive scale up. But the comment I was going to make was that if you go back, for example, to 1992, all right, which is immediately before Claude left Marc Rich, I distinctly remember having conversations with him and with the other traders where we discussed this very topic and said, okay, you can go over to Merrill Lynch and you can earn 10% on your handiwork if you could identify what your handiwork is. What are we doing here? We've got a bonus pool, a collective bonus pool, that if I remember right in 1972, and don't call me a liar because I won't be able to check the number anyway, I remember was 17.5%. And that was for cash bonuses at the end of the year, but did not include the share ownership that people also had in the underlying firm. So the collective was earning a good deal more than the banks were paying. But it was very difficult to attribute a dollar to any particular individual. And this was considered the bailiwick, the talent of the management. And the management's job was to make sure that they took that pot, which they did in fact allocate to pay. So no one was trying to save money by not paying people. But then they had to turn around and spread it around the trading floor in a way that reflected everybody's contribution, which didn't usually come with a number attached to it. So there was considerable nuance involved.
I myself actually met Claude, whatever it was, 15 years ago, a couple of times talking about exactly this compensation. And today, a significant slice of HC Group's revenue comes from, or activities come from around advising on org structure and compensation, so because it is so critical. But I do think that and we're going to tell this story, like that, one of the edges of the trading houses has always been that ability for management to reward, and actually is the teams to the quantums are great, but as you say, it's the teams coming together and working out that year how people contributed, because it takes a team to deliver on that the opportunity set that you just outlined. To wrap this piece of the story up, so who was at Marc Rich's leadership, and how did Trafigura get started and your involvement in that, and then we'll talk about Glencore.
As you can imagine, it was a long and winding road, as the song goes. But if you go back to the beginnings of time, which in this instance is before my professional career, but it's the mid to late 70s. I believe that Marc Rich and Company was set up in either 73 or 74. I could be wrong about that, but that's my recollection. I'm pretty sure.
70, yeah, out of Fibro, right? I guess Mark.
Out of Fibro, yeah. He and Jesselson had their famous fight, whatever that was about, allegedly about Mark wanting to take a big storage position for a flat price trade because he thought the price of oil would go up, which these days no one would use an oil tank to put oil in on an unhedged basis. That would have been inconceivable, because if you wanted to just be long oil, you'd buy a forward contract. You would put it in a tank. If you put it in a tank today, you're inherently doing some operation that has to do with capturing contango or predicting backwardation. But that was not the case in 73. So apparently he wanted to go long, and his idea was to buy some physical oil and fill up tankage and wait till the price went up, which, had that happened, would have made a lot of money. I don't know whether it ever happened or not, but it led to, allegedly, his departure from Fibro and setting up this new company. And they had a number of people who suddenly got rich. So they were very successful. And especially, the 79 oil shock gave this relatively new company the opportunity to become very, very profitable. So the people who were Mark's partners, and he was never the dominant partner. It was called Marc Rich Company, but he didn't own 50% of it or anything like that. He had a wide variety of partners, including several who were particularly close to him. By the time I arrived on the scene, which is, I joined the firm in '86, I knew people in the firm because of my fiance probably 3 years before that. By that time period, most of Mark's original partners had left. They'd retired. They had enough money and they were either old enough to retire, partly because of age, or just rich enough that they could retire early. And Mark was at that point fighting with Giuliani. He was a fugitive technically, so he was living in Switzerland, but he was able to go to Switzerland and Israel, but really no place else. So he had a pretty constrained life, and he only had, from his original partner group, two of the larger partners who were still very much with him, Alec Ackle and Pincus Green, Pinky, they called him. So Mark's broad breadth of original partners had mostly gone, and he had elevated gradually a younger group of guys actually to run the company. Mark and Pinky and Alex were the elder statesmen and were still very much involved, but they weren't running the day-to-day business. And the people running the day-to-day business were Billy Strathatter, who ran metals, who later became, yeah, he became the first chair, maybe even CEO of Glencore. I've forgotten what he called himself when they set up. Danny Dreyfus, who was running Rich Co Grain, Manny Weiss, who was running the aluminum operation, and Claude Dauphin, who was running oil. So those four guys were more or less, they weren't called this, no one had titles, but they were the senior vice presidents of metals except aluminum, grain, and associated soft commodities.
Just on that, so Danny, he's just part of the Dreyfus family that obviously had a long-standing grains trading history, or was he no connection and just...
I'm not aware of whether Danny was part of that Dreyfus family or not. I never, it seems kind of amazing now with the benefit of hindsight, but I never actually asked that question. I don't know whether he was related to the Dreyfuses or not. It's certainly possible because he was the person running what was then called Rich Co Grain and the sugar operation, which wasn't very big, but it existed. And softs were different because softs didn't have the same forward markets, and of course they're perishable commodities. So softs are a really different kettle of fish, as it were. Anyway, those were the four guys, and gradually what was happening was that it became clear that Pinky and Alex were essentially retiring on some kind of a slow schedule, but they were pulling back from the business. So it became pretty clear to Mark and everybody else that his future bed was being made in a world that was going to be Mark Isolato by himself with these four guys. And there was sometimes some tension about how was this all going to fit together? Was he just going to walk away and give the company to these guys, or was he going to try and stick around but in a non-executive capacity, or was he going to try and stick around in an executive capacity and boss these guys around? But of course, this was becoming less and less tenable in the same way that a trading company is all about teams. Mark no longer, was directly having an impact on people doing stuff. He had these four guys running all the significant parts of the business, and they had expectations of seeing their shareholding in the company increased. So as Mark's partners left, what happened was that the company bought back their shares. So essentially they retired the shares. So the inexorable movement here was that Mark was becoming a more and more and more significant shareholder of the company. He may even have bought back some of the shares from these people directly in his own name because there was always employee ownership at Marc Rich that was significant. But I know as the various partners retired, Mark's concentration of ownership was increasing, which implies perhaps some of these shares he actually bought back personally. But the point is, we suddenly arrived at a moment, as the decade turned, it was 91 or 92, when mostly Pinky and Alex were gone. Not completely, they were still there once in a while. I would see them, but they weren't active. And Mark was kind of the only guy at the top of the pyramid, and he owned a really large percentage of the company, and he was feeling obviously a little bit threatened by these four powerful guys who actually controlled the several hundred million a year that the company was making, generated it and directed it, and it was definitely a source of discussion and tension, which led inter alia to Mark hiring his personal lawyer, Bob Tomajan, who moved over from New York and became a kind of, some would call him a Praetorian Guard. Maybe that's unkind, but he was a little bit of a buffer between Mark and the rest of the world. And clearly there were discussions about the future ownership of the company and what Mark's role was going to be going forward, which culminated Willy Strawhatter leaving the company in 1992.
Okay, well, let's park that story there at a cliffhanger, and we'll come back in part 2 and carry it on and then talk about the trading houses over the last decade and today.
Super.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.